The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the February edition of Digging into the BI, where members from the DC Regional Chapter and the Maryland Chapter get together and look at the latest issue of the member-only Better Investing magazine. Tonight, we're going to be looking at Clearfield, Icon, Williams-Sonoma, and MDC Holdings. So thank you to Brian, Ty, Susan, and Kent for helping us out with this presentation. Let's go to our next slide. Here is our standard disclaimer. Just to remind you, we're doing this for educational purposes, and that we believe as Better Investing that you should conduct your own review and analysis of this. If we happen to mention any securities or so, we hopefully will tell you if it's in our own portfolio, but please be aware of that. And whatever sites we show in our presentation deck, it's not an endorsement or promotion of those products or services. And we are recording this, and it will go up on our YouTube channel, hopefully later on tonight, and we'll show you how to do that in an upcoming slide. And let's keep moving and go to our next slide. So for those people that don't know who Better Investing is, this is the main page, and up at the top in the header is throughout, you'll see www.betterinvesting.org. That's how you can find us. And then down below are hyperlinks that will tell you about the organization and its investment education organization and what our approach is in terms of long-term fundamental investing. And finally, all of us that are presenting we are volunteers in the Mid-Atlantic region, and none of us are professionals at this. We do it because we enjoy it. Next slide. So again, just like we said before, where investment education as Better Investing believes is learned by doing. Those are two of the people that were there at the beginning, George Nicholson on the right and Thomas O'Hara on the left. And, you know, we're just sort of following what they've been doing since 1951. So let's go to our next slide. And so here's the YouTube page where you can find us. And there's it written out. The sub is, the channel is at Digging Into BI. If you just go to YouTube and you see where the green spot is down there, just type in there Digging Into BI, you can find it. And the videos that are up there are organized by what are called chapters. And if you don't know what a chapter is, over on the far left in the blue box, there's a hyperlink to telling you what chapters are. But basically it breaks it so you can just listen to, if you wanted to just listen to one particular stock presentation, you can go straight to that. And in return for doing this free program, we hope that you will like the videos, share it with people in your club or friends, and make sure to subscribe. That way we can be able to, with the algorithm, grow the channel. We were trying to get up to 100 subscribers. We hit our latest goal of 75, and we're going to see if we can try to push it up into triple figures. Anyway, thank you for all those people that are subscribing, and let's go to our next slide. And again, most of you are regulars, but if you don't know, this is a quick slide on how to navigate GoToWebinar. Over on the right-hand side in the sort of grayish blackish one is sort of your control panel, and where you have sort of the white arrow with the reddish background, that's how you can open and close that control panel. You're automatically muted. We will open you up the microphones during question time at the end. If you need to write any questions, you can see the blue sort of highlighted box. You can be able to pull that out to be able to type. And we do have two people in our back room helping us out with this. And if you wanted to ever move that control panel because it's in your way, you can grab it where those green circles are and move it like over to the left or upper left or lower left or whatever fits better for your viewing purposes. Next slide. And if you have any trouble doing this, the red arrow will show you where the help button is. That goes straight out to that globe up there, or right next to the globe. A lot of people sometimes have trouble with the audio, and that's sort of that purple, like purplish arrow. If you're on your computer, it should be on computer audio, but you can also do this through a phone call. And the like. And as we say with the green arrow, make sure to download those handouts. You'll get the presentation deck and all 4 completed SSGs that we're going over with this. Let's go to our next slide. And to be able to help you with viewing, This is sort of a way to look at it. If you want to make this bigger where the 1 is, and you see that zoom 86 with a down arrow there, you can click on that and you can get it to full screen so it can take up more space. You can even make it larger than that. And if there's something that looks interesting on the page, you can click where the number 2 is and get a screenshot of it. We move through the slides fairly quickly. That's the reason we give you the slide deck and the completed SSGs, and we keep it up on YouTube so you can look at it later. But that's just a way to sort of help you out. Next slide. So why are we doing this? Well, we want to be able to show you as what you get with a BI membership. If you're not a member, that hyperlink up at the top will give you a 90-day free trial. We're helping out people that are beginners or uncertain with their judgments on either the stock selection guide. Sometimes we use a PERT report. And we're trying to show you what are the best practices if you're a long-term fundamental investor. It's an opportunity for our 2 Maryland chapters, the 2 Mid-Atlantic chapters, Maryland and the DC Regional, and we promote our model clubs, and we also have a Visit a Club program. So you don't have to be in the Mid-Atlantic community to be a part of this, but that's sort of where we're focusing it. But we do know that some of the people in the audience tonight are outside that area. Welcome. We're glad to have you. Next slide. So again, in just over an hour, we're going to do 4 stock presentations, really pretty fast. And 2 of them come from the member-only magazine, what we call the stock to study, and the undervalued feature. And then we have 2 more presentations that people have found either from the BI website or the magazine. They can also come from their personal experience, their own portfolio, or all those other places in the BI community where we find ideas. And that's just really what we're doing with this. So next slide. If you want to know how to be able to find the featured stocks, the stock to study and undervalued feature, you can always go to this hyperlink where the news releases. You don't have to be a BI member to see it. And you can see that these 2 presentations that are leading it, Icon PLC and Williams-Sonoma, the 2 featured stocks, they were announced all the way back in late November, and they already have the announcements for stuff going through to April. So that's how you can find it, member or non-member alike. Next slide. And if you are a member and you want to get notices from headquarters or from the DC chapter, this is where you do it. You sign into your membership, you go to My Account, and you can see where both the red circle and the red line is. And then if you go down to where it's highlighted with the green circle, and it says email and product subscription, you click on that and it will take you over to the far right where that is highlighted in green. And where that arrow is pointing, that's where you can get the local chapter news and events. And before you hit that Save Changes, we'd like you to go up to where the yellow highlight is and get that weekly newsletter from BI. This is for members. And we'll go to the next slide and show you what you get with that. So this is a member exclusive thing for people in Better Investing, and it highlights a lot of the things that are going on educationally, because again, Better Investing is an investment education group. And so you can see they have an interesting, a couple of things I've highlighted where they're looking at insurance company financials is where that sort of yellowish, orangish arrow is. And then they also have an interesting small company growth screen where the blue arrow is. And it comes out at the close of business. If you're not getting it, if you signed up for it and you're not getting it, check your spam filter. It may be there. Let's go to our next slide. So we also have we have Facebook pages for both the Maryland chapter and the DC regional chapter. You do not have to be a member. You can go there. You will have links to these events and other educational events that are coming up. And you can share that with your friends and people in your club and yourself. So look at that. Join us there. Next slide. Brian, why don't you tell us what's going on in the Maryland chapter? You have a couple different things you want to be able to show us.
Yeah, we're going to be putting on a presentation for the SSG at the College of Southern Maryland in Prince Frederick on Thursday evenings, April 13th and 20th from 6:30 to 9. It's the class number is AAA-8000. Go to the Maryland chapter website, and it'll be information will be on there on how you can go sign up, or just go directly to the College of Southern Maryland website. It's about $70 for that. The other thing that we have is a stock pick exercise going on. It started on January 28th. It ends on the 26th. I just checked, and since we haven't had any update yet, everybody is tied for first place. So it's a good start. That's all I have.
Very good. Thank you, Brian. Let's move on. Okay, Cheryl, tell us about what's going on in the DC chapter.
All right, every month we have a Money Matters book discussion. It's on the third Tuesday of each month, starts at 7:30 p.m., usually runs to about 9. And it's a free online monthly book discussion. And there is the upcoming schedule. Trying to read it because the lettering is very small here. But anyway, I can tell you that the upcoming is on the 21st of this month. And we are talking about Build This, the Unexpected Paths to Success from the World's Most Intriguing Entrepreneurs by Guy Raz. He has a blog that he does talking to different people in different areas, and this is an excellent program. I've heard it, and so this is a book that comes from that and puts in some of the high points of the people he talked to and the information he's gotten.
Thank you. Let's stay here on this slide for just a moment. Up at the top where you see it's Money Matters and it's in the blue with the underline, those are hyperlinks. So again, if you download the handouts and you click on those, you will go directly to that location. You can't do it from your screen off of this tonight, but go ahead and download it, and then you can click on those, and all those things that we talk about, you'll be able to find. Let's go to our next slide.
You could also go to the DC regional website and on the betterinvesting.org, and you can also get the link from there as well under events.
And there it is up on the top in this sort of the goldish pinkish thing up in the blue banner.
Yep.
Let's go to our next slide. Brian, tell us about what's going on with the Model Club.
The Model Investment Club that we had was closed, and well, that is being completed, and all the information goes to all the appropriate places, the IRS and everywhere else. We're planning on starting a virtual club without everybody having to send in money, and so we're working on that, and that's where that stands. There's no start date yet, but we're kind of really waiting until after the other one gets done, so we don't get something crossed and cause all kinds of problems. So that's kind of where that is.
Okay. Susan, why don't you tell us about your club?
Got to unmute, Susan. She's having a hard time there. Why don't I go ahead, Kevin? This is Happy Destiny Investment Club, and Susan and Kevin and myself are 3 of the members for that. We started in 2001 with 6 partners. We are accepting additional members. It's on the 3rd Friday of every month from 6:30 p.m. to 8:30 p.m. Education for this coming meeting is Looking Cyclicals Visibly, and the stock to study is CSGP and ZTO. We welcome visitors as well, and the link for that is can be if you send an email later on to either myself, Cheryl Patterson, or Kevin, we can send you the link.
And there's also you can also use that point of contact down there at the bottom, but we'll get back to you. I see one of our visitors is in the audience tonight, so that's great. Next slide.
Yeah. All righty.
And this is my other club that I'm a part of. It's the Montgomery County Model Investment Club, or MCMC. We have 8 partners. We're always looking for new people. We meet on the 3rd Wednesday of the month. We're started out at the Rockville Library, but since the pandemic, we've done everything on GoToMeeting. That's our link. You can come join us. We're going through looking at the first cut reports and seeing if we can use it. Our stock study for this month will be Technoglass. And there's our point of contact. And there's a picture of all of us at our summer social. And we're going to have our winter social this weekend. So that's what we do in that club. Next slide. Ty, tell us about your club.
Sure. The DC chapter has started McNova, a club, about 15 years ago, and we're fairly active. We meet second Tuesday of the month. We have a planning meeting the week before, and we're doing decently. Last 3 years, we beat the S&P 500. It's a good club if you want to learn about investing and the technology, or not and the techniques for evaluating companies. We use stock selection guides, and we do a lot of the traditional better investing type of analysis. We welcome visitors. We've been doing these mostly recently through GoToMeeting, but we welcome folks. You don't have to be a member of the partner in the investment club to participate and come to the meeting. So contact information is here. Hope you can join us.
Thank you. Let's keep going. And Cheryl, tell us about the Visit a Club program that both chapters put on.
Yes, when a club is looking for members for whatever reason, attrition or people have moved out of the area, they can sign up for this Visit a Club list, and then people who are looking for clubs can go to this list on the Better Investing website and find the name of a club and the means to contact them and do so. The other part of the Visit a Club is the directors of either chapter are looking for clubs where we can come and give you a hand with whatever you need, whether it's to learn whether you are how you're putting your portfolio online, to take a look, to dissect it and see if you have enough different types of things that you're invested in, sizes of companies and such. Or, look at the website and see what's new on there and point out some things that maybe you didn't notice that could be helpful. And so we hope that you will contact us. There are contact emails on either website, the DC Regional or the Maryland, and please do. And we would love to come and visit your club, either live in person or virtually.
Okay, so this is digging into the BI, and the January magazine is combined with February. So if you already got your January one, you have your February one. This came out on January 6th, and this slide is just sort of showing you can use the BI app over on the left-hand side to look at it on a tablet or your computer or on your phone. And then the e-magazine is over on the right-hand side, and if you sign into your membership number on BI, you can take a look at it there before it shows up in your mailbox with the paper version. But I've asked previously if anyone looks at it at e-magazine or app, and we overwhelmingly find people still like to be able to read it with the paper in their hands. So that's life. Next slide. So the featured stocks, if you see the article, they'll always mention how there's additional resources. And you can find that's where the red arrow is, where it's analyst reports and resources. But if you go to the green arrow, the Better Investing magazine for mobile devices, that's how you can sign up to be able to either use the app or something else on like I said, a tablet. It's a different sign in than what you'd have for your regular membership. So that's the reason you have to go in there and do that. But this is where it's located on the BI site for those people that haven't done that. Let's go to our next slide. And so we feature usually one article from the magazine this month. And this time I picked out the Between the Lines column that Craig Bramer does. And I thought it was kind of interesting because he talks about how bear markets might be good for investors. And he was reminded of the time that Warren Buffett said that bear markets are great for most investors. And that is if you have a long-term time horizon for looking at it. So again, for members, I found it a very interesting article. Go in there and take a look, and you'll see both the magazine and in the e-magazine, there's a new layout to that magazine. So go ahead and take a look at it. Next slide. And here are some of the upcoming events. This is a standard thing always in the magazine. Most of the events here have already happened, but we're starting to feature this program there in the highlighted green that both the DC and Maryland chapter put together. And we also have, I see some people from South Florida are here, and they've been running some really interesting free online programs. They got one tomorrow night, and it goes a month as well. Go ahead and take a look at that, sign up for it, and take a look. So let's go to our next slide, and I think it's about time we start talking stocks. So yeah, why don't we just get in? We're going to do two in core. So we're going to look at Clearfield and Icon in core, and let's go straight to Brian and tell us all about Clearfield.
Good evening. As Kevin said, I'm Brian Koenig, a volunteer from the Maryland chapter. My company this evening will be Clearfield Incorporated, symbol CLFD. And as I recollect, I became aware of Clearfield while watching a financial show on TV sometime in early January. I think it might have been Making Money with Charles Payne, but I'm not sure. However, since I started my research then, I've seen no less than 4 other presentations on Clearfield. So I'm interested on how my analysis will fare compared to the other people's. Next slide. Clearfield was founded in '79 under the APA Enterprises. In 2008, it changed to Clearfield Incorporated. 2 basic segments, Clearfield Operating Segment and then the Nestor Cables Operating Segment, which was purchased in Finland in May of 2022. Design, manufacture, distribute, and fiber protection management and delivery solutions. Just about anything that has to do with fiber and 5G is what it does, and it's North America and Europe. Next slide. Its products are sold across the broadband service. They have, if it's a national carrier, it's tier 1. Community is tier 2 and 3, local carriers. If there's a multiple system like cable television and that, or if there's a large complex, apartment complex or something, they'll work with them. They work just about anybody that has to do with 5G and fiber. International, as it shows there, Europe and then Latin America, Canada. Its legacy is to build the print, copper and fiber assemblies. And since Nestor joined, its products are sold mostly to telecommunication wholesalers and operators, primarily in Europe. Next slide. Its product line is mainly conducted internally. It builds its own. To bleed the community, it's constantly evolving, and success depends on the ability to anticipate and respond to these changes. It does a lot of work. I looked in the annual report, and there's a whole page of their products. Some of them are proprietary and that, so they do a lot of their own. Or as it says there, they simplify the customer's business using the environment and technology, and developing high quality, innovative products whenever possible. Next slide. Here's the company information off of the SSG. As you can see, when I did the SSG, it was on February 2nd. Closing price is $70.72. I'll talk a little bit. I think it's gone down today. It closed at $63.70. So my conservative estimates will probably look unconservative. Communications, equipment, industry, and the technology sector. It's a small company. It's only got sales of about 300 million. So it's got quite a ways to go before it even gets to the mid company size. And it just has a global presence with anything to do with fiber optic and 5G. Next. Okay, so we go to core, the tab 1, step 3. What it shows here is in green is the sales, historic sales. In blue is historic earnings per share. Up to 2020, it looked to be kind of a steady grower. And then from 22 on, or yeah, from 2020 on, it is doing quite well, as is 5G and other parts of that. Next slide. So what I looked at now was I looked at the competitors, and the competitors are the Gilat Satellite Networks, the GLT, and Aviat Networks, best I can pronounce that one, AVNW, and then Audio Codes, which is AUDC. As we note there, the black across the bottom is Clearfield, and the purple right above it is Audio Codes. And those two look to be interesting and very similar. So next slide. Here for the earnings per share, again, the black line, Clearfield, the purple line for Audio Codes. After 2016 seemed to be very similar. However, the other two look like they're all over the map. So we will, so I got those two eliminated, Gilt and Aviat. Next slide. So now back to this one. We've seen this one before, and so that's what I decided to do that. Now here's something that most people do. They'll pick one or the other, and I've heard so many presentations where they chose one. Well, what I've been going to do is for tonight's presentation, I'm going to do 2 SSGs, and we're going to do the comparison right here to see what we want. Next slide. So for the quick SSGs that I use, here's the data. The sales growth is 10% for both. Earnings per share is 9.5 for Clearfield, 10 for audio cables, and then the 5-year estimate is $5.59 for Clearfield, $1.39 for audio code. The current price when I did this was $70.70 and $20.40. The 5-year average average PE was 23.6 and 26, so those are pretty close. The forecast high price based on a 559 earnings per share in 23.6 PE was $132. The 56 in parentheses is my low, which is 80% of the $70.70. Same thing for audio code was $37 for the high and $15 for the low, which gave an upside downside ratio of 4.2 and 3.0. The compound total return, the potential price appreciation was close at 13.3 and 12.6. The change here was that Audio Codes has a dividend of 2.7%, which gives it a little bit of a lead for a 13.3 to 15.3. So now that we have all this information, what do we usually do with that information to figure it out since they're so close? So next slide. It's a stock comparison guide. So what I did here was I chose ones that I thought were appropriate. The estimated sales growth, since I picked that, 10 for both of them. Earnings per share, 10.1 and 9.5. So I highlighted both of those. In the management comparison, it looked like the debt to capital for Clearfield over on the right at 5.1% was a little bit better than Audio Codes, even though Clearfield bought the Nestor cables and paid cash for it. It still is less than the peers for its debt to capital, so it's doing okay. The valuation statement down in the third box down, the present price, and you divide that by the estimated total earnings per share going forward. And so what you want to look for there is the lower of the two is better. And in this case, the 3.0 is better than the 3.5, so that went to Clearfield. They're both in the buy range. Upside downside 4.2 a little bit better. And down on the bottom, compound annual return, even though it's 15.3, well, for audio codes, we got that. So as you can see up there in the red, we have 4 counts for audio codes and 6 for Clearfield. No particular real winner here. So let's go to the next slide.
5 minutes, Brian.
Okay, so this was my determination was the last 5 or 6 years I gave Clearfield the better because the purple is leveling out, and then the last 3 quarters appear to be going down. So from just that, and I decided to continue with Clearfield. Next. So back to the tab 1, step 3, historic sales and earnings per share. Going forward with 10% on sales and 9.5% on earnings per share. That matches reasonably well with the data there from Value Line or Morningstar, whichever the BI has in their database. So we went forward with that. Next slide. So here are the final results. Over on the left-hand side, the high was $131. The low was $56. The break point between the sell and hold was $113, and between the buy and hold is $75. So the $70.70 was lower than that. When you do the calculations there to the right, you find out that it's 4.2 to 1, and so that's a pretty good upside downside. Next slide. So to determine the 5-year potential, since Clearfield doesn't have a dividend, there is no average payout. So we're down to the 13.3% with no yield. So 13.3% would be the current the annual rate of return. Next. So in conclusion, the Clearfield Incorporated, it's a small size company and probably will be for a while. It's a growth company. Appears to be well managed after the purchase of Nestor Cables. Currently in the buy zone, and as I said today, down to 63.70 close for today. It's probably even further in the buy zone. Trading below its 5-year average PE, and you can see the closing price there, 4.2 and 13%. So if down to 63.70, probably a better upside downside and total return. And with the market being near a bottom, I'm going to say near a bottom. I don't know. It's kind of been bouncing along the bottom. It could be a good small size technology purchase in the communications equipment industry. And if it fits in your portfolio, I'd have you take another look and do a good SSG on it. That's all I have.
Thank you, Brian. All right, so we have one more that we're going to do in core. And again, I see we have a couple new people here. So core is what people usually use when they're just starting out. And Ty, why don't you tell us all about Icon?
Okay, Kevin. So Icon is the stock to study in the January-February edition of the Better Investing magazine. So that's why we've selected it here for this presentation. Next slide, please. And this is just it's good little article if you have time to read it. It covers the article is a good discussion of what to look for in the in a company. This particular company, they're what they call a contract research organization, and they help guide companies through the FDA approval process for new drugs. They work with both big pharma and biotech firms. Big pharma being the companies that focus on the drugs, and the biotech are the ones who focus on some of the newer methodologies for dealing with disease, like therapies involving the immune system. But it's very expensive to get approval for a drug. For very simple very simple approvals, the median is something like $19 million, but it can go up to the billions of dollars to get a drug through all 3 clinical phases and get FDA approval, depending on the complexity of the drug and the extent of the extent of the different phases of clinical trials that they have to run. So this company, ICON, has carved out a niche for itself. It's becoming an expert in doing that. It has a big database of patients. It can help with clinical trials. It knows how to do the process. It's got a big share. It's an Irish company. Used to be about a third of their revenue is from the U.S. Now it's almost half, and currently the other half is Ireland and Europe and the rest of the world. So they're an international company, but they do a lot of business here. Next slide, please. This is it's the second largest company in this space. There's some really big ones, like LabCorp is a huge one, but they're more though in this limited area of contract management organizations, CMO. And this company, along with Charles River Labs, I think are the two to watch if you're interested in following it. Next slide, please. So the size of they clearly hit synergy in terms of size, and they're able to work with big pharma companies, and they have recurring customers in that area. So there certainly is, in this business, there's an efficiency that comes with the larger size, and they're enjoying that benefit. Let's see. That last bullet there is their database of potential patients to help with clinical trials is apparently a big benefit. And if you're a big pharma or you're a biotech company, kind of outsourcing this part of the process makes a lot of sense, particularly if you don't have a lot of drugs coming through your organization. But then even some of the larger companies that have a lot of drugs coming through, or biotech therapies, will still use a company like ICON. Next slide, please. There's a couple of peers here that I mentioned. Charles River Labs. If you're interested in this area, I would follow ICON and CRL. IQVIA is probably the biggest. Syneos is next in terms of their competitors. Next slide, please. So doing the SSG, first thing, and again, we're doing this one with one exception of one slide. We're doing this in the core SSG. So the first thing you want to try to figure out is what's the revenue growth for this company over the next 5 years. Hard to know more than a year into the future, but that's what you have to do to put the SSG together. So I always look at a couple places. Value Line is a good touchstone. Morningstar is another one. Now, Value Line is pretty optimistic here. They're calling for 16% revenue growth. Morningstar called it they didn't give a number, but their Morningstar report called it high single digits. So let's call it a 9. And other analysts are calling for single digit growth. If you go back and look at how they've done pretty well over the last 10 years. They've done about 15%. So I will say with this particular SSG, the number you plug in here for the sales will make a big difference on the outcome, but I used 8%, and I think that's a conservative growth. And when you look at the graph, you'll see they had a huge run up in revenue the last 2 years during the pandemic. That's not going to last. That was all fueled with government money. So I think Value Line is too optimistic. Next slide, please. These are the revenue going back to the core SSG. These are just some plots of those companies that I mentioned to you. The black line is ICON, and you can see 21 and 22 they had really explosive growth in revenues, almost doubled. Next slide, please. So here's what I ultimately settled in. I settled in on 8%, maybe a little conservative. You could bump that up to maybe 10% if you wanted to be a little more aggressive. I think either number would work. Next slide, please. Then the other part of this is coming up with an earnings forecast. And again, I always go to Value Line, and I also try to find as many analysts as I can. And there's pretty much a consensus here among both Value Line and the analysts that they're looking for a good 15%, mid somewhere between 10 and 20 in earnings per share growth. Remember, there's only 3 things that affect the stock price in the future: the earnings growth, the change in the PE, and the dividend. So you have three things you got to figure out, and that's why that earnings growth is so important, and also the PE is important. Next slide, please. So what I did here, this is not a core feature, but I thought it would be helpful to do I always do a preferred procedure on a company I'm looking at, and here's where it plugs in. You can see the numbers here. I started at the end of the last quarter, which they were pretty much at a peak on revenue, but 8%, applied 8%. I assumed 13% for pre-tax for expenses, and then their tax rate, because they're in Ireland, I lowered to 17%. That's what Value Line also projected for the 3 to 5 year time frame. And the data that I had didn't really show any share dilution by buybacks. So that came up with, interestingly, a pretty high earnings per share growth rate of 21.2%. Next slide, please. And this is just where we plug that number in. This is on the core SSG. Now, if you look, that number is pretty good. You can see the other line there. The dotted line is my projection, and then the other projection is what the core SSG shows as the analyst projection. So that was a pretty good, I think, a pretty good hit on the using the 8% and 13% pre-tax profit margin. Next slide, please. Here's the SSG. You take a look at it. I'm only going to cover a few parts of it. Next slide, please. And you have that. You can download that SSG from right here from the website. But here's what troubled me about this in the company. So if you look at 2021, everything's heading in the wrong direction. Their pre-tax profit has dropped. Their return on equity has dropped, and they cranked their debt up. They had a big acquisition about a year ago. So those are all, in my opinion, in the wrong direction. But the one that really worries me the most, and it's why I probably wouldn't buy this stock, at least not now, is their PE is very high. Look at that, a 43 current price earnings ratio for a company that maybe earnings will grow at 15%. So that's almost a 3-to-1 PEG ratio. That just tells me that this company, it's a good company. It's just too expensive. Next slide, please. So here's where I come out on it. The par using the average PE, remember you can do par with the high PE or the average PE. I always like to use average PE. It's only about 6%, and it makes it a hold. You can see from the visual there. Next slide, please. So here's, I guess, here's my thoughts on this. It's a large-sized company. It's moving into mature growth. It has excellent management. All the articles I read about it, they really have first-class management. They know what they're doing. It's overpriced with the PE of 43. I would rate it a hold. If it comes down below 160 in that area, it's currently 244. I would consider buying it. And the return on equity is really low. That's something I would watch as well. Their next earnings report is going to be the end of February. I think it's February 22nd. So if you have an interest in this area, I would look at this company, and I would look at Charles River Labs. Next slide, please.
Well, thank you very much, Todd.
And that concludes my presentation. Yep.
Thanks. So now we're going to look at sort of the ones that are in plus or a little bit more advanced, but not so advanced that if you're a beginner, you won't be able to understand it. And Susan will look at Williams-Sonoma, the undervalued future, and then we'll finish up with Kent looking at MDC Holdings. So Susan, over to you and tell us all about Williams-Sonoma.
Good afternoon or good evening, everyone. Williams-Sonoma. As you are aware, Williams-Sonoma is a specialty retail company. Okay, it operates as an omni-channel specialty retailer with various products for the home. And it also provides home decor products under multiple brands such as West End, Pottery Barn Kids for stuff for kids, and organic bedding. You have Pottery Barn Kids, you have Pottery Barn Teen. And it does made-to-order lighting, furniture, hardware, home decor. and it currently has stores, retail stores in the United States, Canada, Puerto Rico, Australia, UK, and they franchise a lot of their brands to third-party stores in other countries, especially in the Middle East, the Philippines, and Mexico. They also have an online presence. This is I found this company from talking to several other Better Investing members, as well as from several of the people on this webinar today.
Susan, let me know when you want me to turn to the next slide, okay?
Okay, next slide, please. Can you hear me? Okay, okay. As I indicated, I found this. It is in the BI at January 2023, but I also
Susan,
found
excuse
this.
me. This is a mistake here. Go to the next slide. I think I forgot to take this one out. So if we skip one more, that's from last month. There we go.
Okay.
Sorry.
No problem. Okay. Williams-Sonoma uses the ticker symbol WSM. And as won't read everything, it is a small cap company. It's in the e-commerce area, but it's not a typical small cap as BI likes to consider it, because it doesn't quite do meet the criteria that BI lists for small, medium, and large. But what you will find in certain industries is that small cap companies don't always, or even mid or large cap companies don't always adhere to that kind of process. It just depends on the industry. Okay. It is one of the strongest e-commerce retail channel companies that is out there right now, and it's reportedly the country's largest online market of home furnishings. Okay, next slide. Today, Williams-Sonoma is one of the largest e-commerce retailers, and as I indicated, it currently operates in the United States and Canada, Puerto Rico. It franchises their brands to several other countries such as the Middle East and Philippines and Mexico. They also have a strong online presence, which has assisted them greatly throughout the pandemic. Next slide. It leverages its omni-channel specialty retailer status by cross-selling a lot of products for the home, for teens, and for kids. Next slide. So going straight to the visual analysis, as you can see, we have somewhat of an up, straight, and parallel. The sales has been growing fairly slowly, and then on the most recent several years, it has kind of sped up, taken off, as we want to say. And as you can see, you see the same thing in the earnings and pre-tax profit. One thing I would caution is that you should understand what is happening with that dramatic increase in sales, earnings, and pre-tax profit for 2019, 2020, and 2021. You can also see that it is moderating in 2022. And as with most of the companies, it has not escaped the shellacking that has happened in 2022. But we still have growth in the company. Next slide. Williams-Sonoma business is booming, and management continues to eye new opportunities, which we will discuss later on in this webinar. And they have been lucky, and I would say blessed, in that they have continued to prosper even during the pandemic, as most companies that have been selling products for the home has prospered. Next slide. even though we have seen some shellacking of the stock price, Williams-Sonoma has continued to put forth strong numbers. They've had solid comparable store revenue growth of 8.1% in the fiscal 2022, and that was the third quarter that ended in October 2022. Next slide. Okay, growth has been good over the past year, as if we go back to the visual analysis over the last several years, you'll have seen that growth over the last less than 5 years has been 11.2 versus over the last 10 years where it has been around 8. Okay, so the company has kept its store shelves stocked to meet demand, which has given it a competitive advantage right now, and they have been able to grow their earnings per share by about 18% for the first 9 months of 2022. We're still awaiting the final quarter numbers for 2022. Next slide. Here is management evaluation. As you can see, we've had pre-tax profit. The 5-year average is 13.9, where 2021, the numbers are 17.8, which is good. You've seen the numbers typically from 2017 start increasing. Percent return on equity, again, has been increasing, which is good for the company. And debt has been decreasing. It started at 19, got all the way up to 43, 44, and then started coming back down slightly. So that is one area that I would continue to watch, is to make sure that the debt that they have taken on can be managed adequately. Next slide.
5 minutes, Susan.
Thank you. However, as with all of the good things, there's always someone that has something else to say. So there is, as we are all aware, possible recession is on the horizon. There has been discussions for the latter half of 2022 into the beginning of 2023. And the question is, how will the company handle that? And this has impacted the stock price significantly. So that is another item that you would want to be aware of. Next slide, please. Moving on, we're looking at the high and low closings for the year, for the last 5 years. And as you can see, and this is historic information, you can see that historically, the average earnings per share is about 13, PE ratio is about 13.4, whereas the current PE ratio is about 8.5. This typically indicates an undervaluation of the stock. But again, do your own research, because it could be correct because of, pricing in certain factors that I may not have taken into consideration, but it would be interesting to see what others think. Next slide. As I indicated, there's an undervaluation showing up in the company's PE ratio, and the stock has been beaten down about 38%, and it's about 8 to 9 PE. And the market is saying that they typically trade at around 20. So they think that there is room for PE expansion going forward in this stock. Next slide. As we all know, Williams-Sonoma benefits as more people entertain at home. And the company just launched a new website in India last year and opened its first Pottery Barn store in India, in New Delhi. So they are excited about those opportunities, and that it hopes that it will, they hope that this will benefit the bottom line. Next slide. Here is evaluating risk and reward for the next 5 years. I use the PE, that average PE that the company normally trades at based on better investing, which is about 13, based on the estimated high earnings per share from a projection of 8% on sales, which brought earnings to about 23, and it has a high price of $302. Low price, I use 6 PE because this company has been beaten down so far, and current earnings of 15, which gave us a forecast low price of 98.6. And this currently allows us the stock price today to be in the buy zone with an upside downside ratio of 3 to 1. Next slide. Okay. So again, this is I have looked at Value Line, I have looked at CFRA, and I've looked at Morningstar. And Morningstar and Value Line thinks that this company is a good buy at this point. CFRA thinks it's a hold. It has 3 stars at CFRA and 4 or 5 stars at Morningstar. So we have a mixed picture going forward, but Value Line thinks that their new business-to-business initiatives that they have been implementing will be a significant growth driver. Next slide. And so Value Line is slightly gung-ho on this company. The company themselves is also high on this business-to-business initiatives that they have implemented and hope that it will be a long-term driver of profits for the company. CFRA, they like the business-to-business initiative as well, but they're a little bit more cautionary on the issues that go on with this company. So looking at what's going on, next slide. The business-to-business grew 17% year over year, and it has significantly driven the sales and earnings going forward. But I have also taken into account that this typically is a company that grows around, I would say, on a 10-year period of about 8%. So that's what I used for my sales growth going forward. I would like to see that this high-end retailer would provide significant tailwinds going forward. Next slide. In conclusion, Williams-Sonoma is a medium-sized, it's a slow growth company. It is well managed, and it's currently undervalued based on BI's methodology, Value Line, and Morningstar. As a mid-cap medium company, I think it is worthy of further consideration. There are some red flags to the company that would bear monitoring. It is a buy below 149 to satisfy the 15% total return. And that's all I have for this afternoon.
Thank you very much, Susan. And last but certainly not least, Kent, tell us all about MDC Holdings, all the way from Alabama or wherever you are in this world.
Well, thank you, Kevin, and great job, Susan. Thank you very much for that informative presentation. I am calling in from the Alabama Emerald Coast chapter, and I'm glad to be here with you as we explore MDC Holdings. Next slide, please. I decided to study MDC for three reasons. First, I found it in several first cuts over the last several years. It was presented at the very first Digging into the BI Magazine webinar in November 2020. And full disclosure, because of both of those things, I actually own some shares in the company. So I really wanted to see a little bit more about what it's been doing recently, since I hadn't really done an analysis in the last year or so. So what is MDC Holdings? Next slide. So as you can tell, it has housing subdivisions in multiple places, including Baltimore and Western Maryland, Southern PA, Washington, D.C., so all places that we're familiar with, as well as down in Huntsville, Alabama, which is a brand new area that they are growing some houses down there in Hazel Green, just north of the city of Huntsville, which is what I learned. They actually are calling that Tennessee for some reason. I'm still trying to get clear on that concept. Next slide, please. So as you can see, the revenue has been up 15%. The pre-tax profit has been up 32%, and the earnings per share has been up 33% over the last 10 years. Conservative future estimates that I saw yielded a buy in doing this quick MDC SSG survey back in December, when I looked at this and said, you know, this is the one that I wanted to take a look at. Came out with a really good upside downside ratio. So I thought, you know, it's worth a look at. Next slide, please. So MDC has two complementary business lines. They earn money in two ways, both in home building, which is a majority of their revenue, as well as financial services. And one of the things to note is that financial services actually provide a greater pre-tax income in proportion than a greater pre-tax income than in proportion to their revenue. So in other words, their revenue is only 2%, but they're providing 9% of the pre-tax income, which was very interesting to me. Next slide, please. And yet, despite the sales growing at a compounded rate of 15%, industry analysts are predicting a really severely negative downturn for MDC. And so my question is, what is going on? And I found it very curious. Next slide, please. So Value Line gives us a great hint as to why. There are two things working against MDC. Buyers are leaving the market, always bad for a house building company. And then there is also an excess supply of houses now, also really bad. Next slide, please. Over the long term, Value Line is pretty bullish, but the short term is going to be particularly ugly. And so, you know, there's a reason there for that negative 36% growth rate over the next 2 years. Next slide, please. These are some of the data points that we really want to include in our analysis. I mean, the fact that new order value, the dollar value of new houses, has contracted 88% in 2022 compared to 2021. Now, just so you all know, their annual report just came out on Wednesday, and so I'm still looking through it. But this was a real eye-opener on what Value Line had to say. And so that's very interesting. Next slide, please. The Value Line analysts, and there's actually an analyst following this in Value Line, which is unlike CFRA and now Morningstar. They're doing their automated following. The Value Line analysts indicated that the late November price, MDC was a really good buy. So I was kind of curious, well, what about today's price? Next slide, please. So given the 2022 end of year reports just came out, I got the annual data imported into my stock selection guide and through 2022, and there's a lot of good growth that MDC and its peers have been exhibiting over the last 10 years, including 2022. And the peers are really matching quite well, and MDC is matching its peers quite well in its sales growth. Next slide, please. So the pre-tax profit for MDC has started to edge over, whereas the peers are continuing to climb. So that's something of concern. And so I need to find out a little bit more about what's causing those peers to climb versus MDC. Next slide, please. Their earnings per share growth, MDC's earnings per share growth, has declined. And it's very stark compared to the peers, especially KB Homes and Meritage Homes. Their earnings per share have continued to climb. So another thing of concern. But still that long-term MDC growth is the highest of all its peers. So I got a bit of a conundrum here. Next slide, please. Profit margins, because of this decrease in earnings per share growth and the nosing over of pre-tax profit, the pre-tax profit margin, the pre-tax profit over sales is trailing in 2022 compared to its peers, all of its peers, and it primarily due to a significant underperformance in the financial services part of the business. The amount of mortgages that they were able to sell, the amount of insurance that they were able to sell, mortgage insurance they were able to sell, all of that dropped off considerably with the retraction of buyers, buyers exiting the market, as well as people canceling their contracts. So that was a substantial problem for MDC. Next slide, please. Our return on equity is also down, which is not much of a surprise given that the downward movement of MDC's earnings. Next slide, please. So MDC is essentially on a downward trend with their debt, which is really a good management move, especially given what they've been experiencing with their buyers. And that downward debt is because they are buying less land to match what their market conditions have to bear. Yet that debt is still higher than its peers. So again, concern. Next slide, please.
5 minutes, Kent.
Thank you. After looking at Jonathan, after looking at Yahoo, Zacks, Morningstar, and CFRA, I decided that the best way to forecast sales 5 years out was to match the value line statistical growth rate for sales, and I basically matched the expected sales 5 years out with value line, which resulted in a negative 0.6% growth rate. Then using that growth rate, I use a preferred procedure to estimate what kind of earnings growth we could expect. And that really took it down to like the negative 3.5%. This is really disappointing. And the other thing that's also interesting is that the tax rate, given the losses that MDC is expecting, I would expect this tax rate to go down. But because of the gains they've had over the last couple of years, their tax rate has been increasing, thus reducing their earnings per share. These earnings per share and sales growth rates are disappointing, yet I think realistic from my point of view. Next slide, please. Forecasted high and low PEs. I think there are, given a potential recession and given the shrinkage of the market that's expected, I chose these 2022 PEs as the lows and the highs moving forward, thinking that at best, this is what it's going to be for the next 4 or 5 years. Next slide, please. Given that information, I calculated the expected high price as $47.50, and next slide, the expected low price as $26.80. And so that's kind of where we should look to see what our current price compares at with that. So let's take a look at the next slide. I think as a result of the federal, the Fed's slowing the Fed funds rate increase, so in other words, decreasing the next interest charged for banks, MDC has had a significant run up in price in January. Because when I looked at this in December, its price was significantly lower than it is now. And as such, the current price is well above the buy zone. In fact, I think it's got to drop, $13, $14 for it to be back in the buy zone. Next slide, please. And the 5-year potential out to 2028 is, given the elevated price, the average PE par projected annual return is only 2.2%. And so at the expected return of 2.2% in the long term, with my conservative projections, is still not a great recommendation for this company. However, I will say that their return on cash invested at 5% is still way better than a bank. Next slide, please. And one of the things that I found really cool that I saw last month for the first time, thank you, Kevin, is that BI's audit tool, which I thought was a really cool feature. So I decided to take a look at that. And as you can tell, MDC has some significant challenges with higher interest rates and a lot of red flags that came up as a result of the audit. So that was very interesting to see. Next slide, please. Finally, MDC's managers are working really hard to move resources and adjust the company's focus to really deal with this current interest rate environment. My suggestion would be look at this company and wait for a much lower price. Next slide, please. There we go.
Thank you, Kent. And as Kent was talking about with the audit, what I've done now with this cycle, all those SSGs that are in there, it's a PDF of our SSG, but I added both the audit and the quarterly data report. So you'll get more than just 2 pages of that. So you'll be able to see the audit on all 4 presentations tonight. So again, go to the handouts and make sure to download that to take a look. But now we're going to go through a little bit of a recap for all 4 stocks. There they are. We know we went through them very, very fast. But let's go to the next slide and we sort of ask our panelists where you think this company is in the T. Rowe Price life cycle of a company. And why don't we start first with you, Brian? Why did you pick that location near the explosive growth for Clearfield?
Well, after they purchased Nestor cables and they started to increase their sale or their earnings per share quite a bit in the sales, but basically because they're in on the early parts of 5G, and 5G is going to be growing for quite a while. So I figured that it was as close to explosive growth as anything that I'm going to see for a while.
Very good. And Ty, tell us why you picked that location for ICLR.
Well, essentially ICOM had gone through a very, it was a steady growth, and then it had 2 years of explosive growth, and now I think it's heading back into a more steady, consistent growth. So it doesn't really fit this curve exactly, but that's about the best spot for it, I think.
Okay, thank you. Susan, why did you have that location for Williams-Sonoma?
As Ty indicated, we had very slow growth for the first couple of years for this company, and then it made some adjustments and they came in with some significantly higher growth. But as you can see from the visual analysis of the company, it looks like growth is starting to slow slightly again. So, and being that it's a mid-sized company, it doesn't quite fit the explosive growth category, because even though the margins and the growth cycle sits more of a larger cap company in that space. So while it may be a mid-size, it's one of the larger companies and it grows like a large company. So that's why I thought it sits in a better position of mature growth.
Okay, thank you. And just before we go to Brian, if you see that hyperlink down there with the digital handbook, this is in the digital handbook. And if you don't have it, you can go there and get a ebook version of it for, I think it's like $25 from BI. But Brian, tell us about why you put this, or Kent, I'm sorry. Kent, tell us why you put that location for MDC Holdings.
Well, MDC has been around since 1972, and they pretty much have had a steady growth pattern for the last 10 to 15 years. And so given challenges in 2008, they had a steady growth pattern. And so I think this is gonna continue on in that steady, mature, slow, keep moving forward growth rate. They have a lot of peers that are out there that are competing for the same customers. So I think we're in the mature growth pattern for MDC.
Okay, thank you very much. Well, we've been chatting for a while, but let's go to our next slide, Cheryl. And we can release the poll. And again, we're not asking so much which one you think is a buy right now, but which one intrigues you enough that you want to do further research on. So go ahead and release a poll, and all of you that are not in the back room as panelists have an opportunity to vote. Hopefully you're still with us, and we'll see how we're doing. Okay, votes are coming in. Let's see, we're just over 50%. Can we get a little bit higher? Yeah, we're moving up over 60. Can we get up into the 70s? Yeah. All right, now I'm going to push, see if we can get to 80. Come on, we're pretty close. Yeah, we just got over 80. One more. I feel like an auctioneer. Okay, it looks like it's holding, so go ahead and close it. We got 81% of you. And let everyone see. So there it is. Brian, you got the big winner. People like Clearfield. That's been really popular in the BI community. It's shown up, as you said. Everyone seems to be talking about it right now. So go take a look at Clearfield yourself. Do your own research. And let's continue with that and go to our next slide. And this is where you can be able to reach any of us, whether you're with the Maryland chapter, the DC chapter, or if you want to reach out to digging into the BI. There's a picture of some of us, and I just got told that one of our presenters there was like, we ought to get a new photo. But that's us at Bank last year in Dallas. Thanks to all of the folks there and the people tonight that presented. And let's go to our next slide. And again, you don't have to be in the DC chapter. And again, if you see up at the top in sort of in the banner, that's where the DC regional is. You can go ahead and join our mailing list, and our resident Interspire person will not bombard you, but just with educational opportunities like the book club and like this digging into BI and any of our educational presentations right there. Please do that. And let's go to our next slide. And Kent, why don't you tell us all about volunteering?
Okay, so if you have liked what you saw this evening, if you think that it was helpful to you, please let someone else know that you care about or that you think could benefit from the knowledge that you've gained this evening. Next slide, please. If you would like to volunteer for any of the chapter activities, either the DC chapter or the Maryland chapter or any other chapter you happen to be dialing in from, and that might show my age, talking about dials. Anyway, the chapters provide various learning opportunities in the form of serving as volunteers. You can help educate other people. You can learn new skills, and learning while teaching is a great way to improve your own investing skills as well as improve your own investing experience. And so by creating that knowledge, by helping out with the chapters, you can earn discounted rates to various BI national educational funds. The Better Investing National Conference is one option. You can also get discounted discounted access to the Better Investing tools as well. And so that's a real helpful thing to have. So next slide, please.
I forgot to do, I do this all the time. I race right through. Carol and Jonathan, do we have any questions in the audience? I went right through it, and we'd like to hear from you now that we've been yakking for over an hour.
I don't see any, Kevin.
Okay. If you do want to ask a question, you can also raise your hand and we'll unmute you so you can join us that way. So again, Jonathan or Carol, if you happen to see anyone raising their hands, you can take that little icon and let us know that you're there and you want to let us know what's going on.
No raised hands.
Okay, I do see Robert asked about Williams-Sonoma, and the growth rate for existing was 8%, excellent. And it had Ross Store managed was picking at 4%, and Costco depending on membership and membership versus sales for income. Robert, if you want to, we can unmute you, and you can, maybe I didn't say that as well as I could, and you can sort of elaborate, and we'll give it over to Susan. Let me find you and unmute you. So you're muted on your end, Robert, so if you want to hit that microphone icon, click on it, you can open it up, and you can ask Susan's question. Saw your hand go, but go ahead, there you go.
Yeah, no, it wasn't a question. It was a comment.
Okay.
I thought that 8% was excellent for same store growth rates for retail. I mean, if you, those are just two others I know about. We have Ross Store in our investment club, and I've looked at Costco before. So to me, 8% is excellent growth rate. I don't know how you indicated that was been for quite a while, so I guess it'll continue.
Okay.
Did I hear you right?
That was Susan. Susan, is that your assessment?
Yes, that is correct. The company from, if you look at the original SSGs, I removed several of the earlier years, and with the earlier years, the growth was very, very slow. You could see it did slope upwards, but it was not as fast as the latter years.
Well, I thought you said 8% for.
Well, I selected 8% because the 10-year growth rate is around 8.
Oh. Okay, it's not just existing stores.
No, yeah, the existing stores is growing. Yeah, it is actually, the existing store growth is around 8%. But for the, the typical growth for the companies as well.
Well, I mean, they've got a an internet presence. They have a website you can buy from, and they have the business to business you mentioned. So it looks like they've got, for retail business, it looks like they've got a pretty good growth story.
That is correct.
Okay. Carol or Jonathan, do we have any other questions from the question box?
Someone just asked about the spring SSG class, and so I think I did respond to everybody, but just so that everyone knows again, in case you're not looking at the chat, the dates for the SSG class in the spring are March 25th and April 1st. Kevin teaches that class as well as Cheryl. They're very, very popular. Both of them are excellent instructors. You don't want to miss it. And the price, I forget exactly what it is, but it's so reasonable you can't afford not to. You have to be there. Let me just put it that way.
Yeah, I believe it's 30 for both classes, and then I think 10 parsed out for individual sections of it.
And just to give fair stuff, again, with these handouts, Brian, remind us again, you guys have an in-person one if you're in the Southern Maryland area. If you're anywhere from like Anne Arundel South, it's pretty good to get to. I'm up here in Baltimore, and we can still get down to Southern Maryland, not too far. What are your dates again, Brian, for the SSG class that the Maryland chapter teaches?
And it's at the Prince Frederick campus of College of Southern Maryland.
Go ahead and say
it. It's $70 because it goes through the College of Southern Maryland.
Okay. What are the dates again? I think you broke up a little bit on me.
April 13th and April 20th.
Very good. And Brian's one of the instructors, and I think it's what, you and Roger, is that right, Brian? Okay.
Yes, I'll be there the first one. The second one, I'm going to have to talk from Hawaii.
Oh, that's a tough deal. I also see we have a question here. Matthew was asking about Old Dominion freight lines, that you'd like to have that featured as one of the stocks. Well, Matthew, if you want to, we can certainly help you do a presentation on that to get there. Are you willing to consider? We won't leave you out on the lurch like that. We'll sort of work with you, but it's a great idea. And if you want to, here it is. I've unmuted you. Can we? So if you want to hit your microphone icon, yay or nay. If you're not comfortable yet, we can work with you on that. We do have some openings in April, May, and June. Yes? No? Didn't mean to call you out, but I did see that, and I do have some openings. So again, anyone in the audience, like I said, we're all volunteers. We'll certainly work with you on that. And that's been one of the great successes of this webinar. We've had, I think, 26, 27 different presenters in the 2.5 years, 2.25 years that we've been doing this. So thanks to all for doing it. Looks like I saw one more question. It said, what, 25% sharebacks in the last 10 years on Williams-Sonoma? That's from Don. Do you have, Don, if you want to say more, go ahead and unmute yourself. But Susan, is that correct, what Don was talking about? Yes? No?
Sorry, yes, as you know, with a lot of companies recently, a lot of them are doing stock buybacks. And with the decline in the stock price, whereas it's almost about, a little bit less than half of what the current PE has been, it looks reasonable to buy back their stock, especially as they're going gangbusters in the retail market.
Okay. Don, since your microphone's open, do you have any follow-up questions you want to deal with on this company or any of the others?
No, just wanted to say I did look at their website as you're presenting, and it's very impressive. They've got great customer connection, great social activities, social activities, and also really well managed. No long-term debt. Over.
Very good. So Don, are you in the area or are you from outside the area? Are you in Maryland, DC, or Virginia? Or are you visiting from somewhere
Virginia.
else? Where are you?
Virginia.
Okay. Are you in a club?
No, I had picked up a book about investment clubs. I've been studying the topic for probably 20, 25 years, but have gotten a lot of interest in the last couple of years specifically. So really enjoyed your presentations, and some of my analysis is very close to what you all have been presenting in the last year or two on several of the companies. So yeah, really appreciate the opportunity and to participate and observe firsthand.
Very good. Well, like Ty said at the beginning, make sure to download the handouts and make Nova, the Northern Virginia model club. Ty, Cheryl, and Carol, and a couple others, I think, in the audience are all part of that club. So you may enjoy that if you like those presentations. I'm sure they'd love to have you, even as a visitor.
Yes,
Any?
I think all these clubs are open to visitors.
Absolutely. And I see we have a couple people, Cheryl, in your second club with me is that a couple of them are in the audience tonight. So thank you for showing up. Glad to have you.
All right.
Any other questions? Am I missing any? Carol, Jonathan, do you see anything there? Well, okay.
I don't see any other questions.
Okay. So here are the stocks we're looking at in March. It's going to be RH Inc. is a stock to study. FedEx will be our undervalued feature. Technoglass and Fox Factory Holdings will be our other featured stocks that are in there. Please come back and see us in 28 days. We will be doing this again. Glad to have you. I think we got one or two more slides for people that want to. We do sort of watch over some of these things. Let's go to our next slide, Cheryl.
All righty, hold on. I tapped out. There we go.
So we have up on Manifest dashboard, you don't have to be a member. Some of us are. It's a separate thing from BI, but we do have dashboards where we sort of track all the stuff there. There are all the different dashboards that are public that you can take a look at. We put them in for the winning selections, those that were like Clearfield was tonight, and each one's for each of the years that are doing it. So let's go to our next slide and I can show you it. You can also find it through the public dashboards. Again, you don't have to be a member. You can see it there. But again, I have hyperlinks on all of these, again, the blue underlines. And if you go to the next slide, slide 112, you can see all of the ones that we have there. Click on them. All of the public ones start out with digging into BI, and you'll be able to find them. And then one more slide, and I saw that Carol answered this one, but you can find us up on YouTube. We did a portfolio one 2 weeks ago, and we also have all of our stuff going back for about a year and stuff like that. So go ahead and take a look at that. Make sure to like, subscribe, and share those videos with anyone else who you want to be able to help entice into investment education. That is what we're here for. Thanks for visiting. Glad to have you, and we'll see you next month when we dig into the BI in March. Good night, all.
Kevin, I also wanted to add on that person who was interested in a review of a certain stock. If you belong to a club, by presenting, it's an excellent way to advertise and promote your club, especially if you're looking for additional members. There are several people who are directors that formerly of Department of Defense who are PowerPoint masters, and we'll be glad to help you on that aspect, as well as helping you with choosing material to put on slides.
Okay. Looks like we have one more question in there. Did we get them all?
No, I was just going to say, or they may be interested in a club visit also.
Yes.
Yeah, exactly. Exactly. Okay. Well, with that, we will let you go and see you next month when we dig into the BI. Good night, all.
Good night, everybody. Hey, Brian, are you still on?
Yes.
I would be very interested in how you got that shot of the website where they tell you if it's a large or small or whatever and what industry and sector and all that. I have been trying to get a screenshot of that, but whenever I go to my screenshot thing, it like fades out of that particular one that you have to kind of hold your mouse on it to get it. So if you want to.
I know what you mean. Okay. Go to when you
Here, let me get out of this.
Okay. You're talking about Snagit, right?
Yeah, I've got a snipping tool is what it's called.
Oh, okay.
And that's the one I use. But so let me just get in there real quick and pull up a that out of the way. It's always that menu. It's in my way. I have a large menu for being in the organizer. Come on, there we go. All right, there's my studies. Now I'll go to last one that I put in there. And when you hit on the word company, that's the thing that I'm trying to get the screenshot of.
Okay. The way that I do that is the one that I use is Snagit by TechSmith.
Okay.
And one of the features that it has is there's a 5-second delay. And so what you can do is you get, a lot of times when you hit, to snip it or to snag it, as soon as you hit that, it stops the screen and you get what you have there. And so, but if you have the 5-second delay, what you do is you select that and then you can put your cursor on like you did to get the company, and in 5 seconds it counts down, and then it freezes the screen open like you have it there, and then you just highlight what you want. And so that's a feature of Snagit. I'm not sure about the snippet one.
Yeah. Okay.
Yeah, Cheryl, I use Snagit as well. It's like $15 a year, and but if you want to, just look in snipping tools, and you may be able to find something for a delay. If you just sort of search under that, you may find that there's that feature inside the snipping tool as well.
Okay, great. Thank you. Appreciate it.
And one more thing before you go, when you do get Snagit in TechSmith, they have tutorials, a lot of them on their website, and then about every 6 weeks or every 2 months, you get an email saying, "Hey, we're going to have a live broadcast," and they'll go over part of what they do, and they're very helpful. So what you get for that, 15 or 25 a month or whatever it is, I consider that well worth it when you try and put on presentations like this.
Okay.
And it's 15. It's like 15 a year, not a month. It's very
yes.
Yeah. So
good.
Yeah, when they first came out, it was like $30, $40 a year, and sometimes for each version. And now that it's an online, they just update every year, so it's a subscription as a service now. So
got it.
Anyway, that's it. But we'll see everyone next month.
Good.
Good night.
Okay.
Good night, everybody.
Good night, everyone. Thank you for coming.
Good night, Susan.
Good night.